Hello, and welcome to this webinar on IFRS 16. I'm Catherine Donkersley, and I'm joined today by IASB board member Darrell Scott. This is the seventh in a series of webinars following the publication of the new leases standard. Just to note before we start that, as always, the views presented in this webinar are those of myself and Darrell, and do not necessarily represent the views of the board or of the IFRS Foundation. This webinar will be a little different to the others in the series. That's because, rather than working through any of the requirements in IFRS 16, we'll be focusing on some implementation questions that we've heard from stakeholders. These questions relate to the assessment of lease term. We'll be assuming today that listeners are already familiar with the lease term requirements in IFRS 16. For that reason, we recommend listening to our previous webinar on measurement before listening to this one if you haven't already done that. You can see on this slide a very high-level summary of the questions that we'll be talking about. I'll summarise the questions we've heard from stakeholders and ask Darrell to share his thoughts on them. Now, some listeners may be thinking at this point that it would be unusual for a board member to give an opinion on any particular fact pattern that we've heard from a stakeholder. So, before we start looking at any technical detail, Darrell, would you be able to briefly summarise exactly what IASB board members and staff can talk about with regard to applying an IFRS standard to particular contracts and fact patterns, and what listeners can expect to get out of our discussion today?
Sure, Catherine. You are right, this does feel a little bit unusual. Clearly, we can't talk in this sort of webinar about specific scenarios. Under any IFRS, it's essential to consider all facts and circumstances, and particularly those where there is judgment involved. And we'll never have enough information in this kind of scenario about specific contracts to be able to do that. So if after listening to us today and reviewing the literature you still have questions or you think you have a difficult judgment to make, then we still recommend that you talk to your auditors or advisors about the specific contracts that you're dealing with. That said, the board is increasingly getting ourselves into a space where we believe supporting implementation is an important part of our role. We don't set and forget anymore. So we're always interested to hear the implementation questions that are coming through the process. And if we hear similar concerns from different sources, we will consider whether talking about what is in the standard and why it is there will be helpful to the implementation process, and as importantly, won't be disruptive to the process that entities are already going through. So this webcast has arisen because we have heard similar questions about lease term from many of our different constituents, and we do think it would be helpful to provide some background about what is in the standard and what the board had in mind when developing the requirements.
Thanks, Darrell. And so most of the questions that we'll be discussing today are focused on the implementation of the paragraph that you can see on the screen now. This is one of the paragraphs from the application guidance in IFRS 16. The paragraph talks about the fact that a company needs to determine the period for which a contract is enforceable and the circumstances in which a period covered by a lease contract would not be enforceable. As you can see on the screen, this would be the case if both parties to the lease have the right to terminate without permission from the other party and with no more than an insignificant penalty. The best way to think about exactly what the board had in mind when developing this paragraph is to work through some example fact patterns that we've heard companies talking about. We'll start with a simple scenario and go from there. So this slide summarises the first fact pattern that we'll talk about. Here we have a lease with a maximum contractual term of 14 years. Every 2 years throughout the duration of the contract, the lessee has a termination clause which allows it to exit the lease. The contract does not require the lessee to make a termination payment to the lessor if it exercises one of those termination clauses. So, Darrell, what are your thoughts on this scenario?
So, Catherine, this is a nice, easy scenario. We don't need B34 to help us out in this one. B34 applies, as you mentioned, when both parties have the right to terminate. But as you can see from this example, only the lessee has that right. And that means the lessee essentially has the absolute right to enforce this contract over its entire 14-year duration, unimpacted by any preference that the lessor might have in the circumstance. So the question in this example then becomes entirely about the duration the lessee is going to choose to enforce. And that brings us, I guess, to a sort of a second test, if you like. The first was, what can the lessee do? And the second is, what is the lessee reasonably certain to do? For the lessee to assess reasonable certainty, it'll need to consider a few things like, for example, whether it has a significant economic incentive to renew, or whether there's some interaction with other contract terms that indicate it is likely to extend, or perhaps look to its past practice on how it has typically used this type of asset in its business in the past. To help the lessee think about the second test, you can look to the requirements and application guidance that are already in IFRS 16. And if you need more, this guidance was discussed in detail in that IFRS 16 measurement webcast that you mentioned earlier.
Yes, it was. Thank you, Darrell, for that. So let's move on then. Next, we have a very similar scenario, but with one important change to the fact pattern. In this case, the termination option every 2 years is an option held by both the lessee and the lessor. Again, if either party exercises that termination clause, the contract does not require a payment to be made. So the key change here is that the lessor now has the option of terminating the contract as well. So does that change anything?
Absolutely, because now both parties have the option to exit. So B34 clearly could apply in the circumstance. So now we move on to the second part of B34, which requires us to decide whether terminating carries no more than an insignificant penalty. Now the fact pattern seems clear, if I look at what's on the screen, that there is no specific termination payment, and a termination payment is clearly one kind of penalty. But a penalty could arise in other ways. For example, if either the lessee or the lessor will suffer some other kind of economic outflow as a consequence of terminating. So things like costs of relocating or finding new tenants or dealing with leasehold improvements. Then there is a penalty, even if it's not explicitly in the contract the way we might think about it. So only if the lessee has concluded that there is no more than an insignificant penalty of any sort, then the contract would not be enforceable beyond the initial 2 years, and the lease term would be capped at that 2-year period. If there is any penalty that is other than insignificant, then the contract would be considered to be enforceable, and if that is the case, you need to assess the lease term as in the last example that we discussed on the previous slide. I think it's worth reiterating a key point here, though. When the board developed the requirements in B34, we were thinking of a broader definition of penalty than just, say, a termination payment in the contract. So when you apply this, you need to think about the substance of the contract, not just what the contract lessor refers to explicitly.
Okay, so overall then, is it fair to say that putting in a termination clause that is exercisable by both parties with no associated termination payment does not automatically make the contract unenforceable?
Yep, I think that's correct. That kind of clause would need to have real substance. In the example on the slide, putting in termination clauses that don't have any economic meaning for the two different parties would not be enough to prevent a lease term of 14 years being recognized on the balance sheet.
Okay, thank you. So moving on then to a slightly different scenario. In this case, we've got a lease with a fixed term of 10 years. After that 10 years is up, the lease will continue indefinitely until either party terminates. Either party can terminate by giving 3 months' notice, and similar to the previous example, there's no termination payment in the contract. So the questions we've heard here are around whether the lease contract is considered to be enforceable beyond 10 years, and if it is enforceable, then how to go about determining the lease term in the absence of any kind of end date.
So thinking about the enforceability or whether it is enforceable, the considerations here are very similar to the ones that we've discussed in the previous example. So again, B34 needs to be considered, and because both parties can terminate without permission from the other in this beyond 10-year period, the question then revolves again around whether there is a penalty to consider. If each party would suffer economically were they to exit the lease, then there is likely some kind of penalty to be taken into account, and thus the contract would be enforceable in those follow-on periods. And if enforceable, then you need to consider if the lessee is reasonably certain to extend beyond the 10 years, and if so, how far. This is hard, and especially because there is no specific contractual end date to consider. But equally, it is really important. Our aim in developing these requirements was to reflect in the entity's reasonable expectation of the period during which the underlying asset will be used, because we believe that approach provides the most useful information. So that's what companies are aiming for when they're making judgments about this lease term. It's good to remember the application guidance in thinking about how you might go about this process. We discussed the application guidance earlier. A good one that you might want to think about as an example is that past practice matters. So how long has the lessee typically used this kind of lease for in the past?
Okay, thank you. We've got one more example, and this final example covers a slightly different topic, and it's another one that we've heard stakeholders discussing. So here we've got a lease with a 10-year fixed term, which, applying the requirements in IFRS 16, will be recognised on the balance sheet. At the end of that 10 years, the lessee has rolling 12-month extension options. In other words, it can extend the lease for another 12 months at the end of the contract, and then another 12 months after that, and so on. The contract has no end date to these potential extension options. Now, there are some initial questions here about whether the contract is enforceable beyond 10 years and then what the lease term is. However, we've already discussed those questions, so we won't repeat that discussion. A new question arises if we assume that, first, the contract remains enforceable, second, that the initial term is assessed as 10 years, third, that at the end of year 10, the lessee extends for 12 months, and finally, the lessee concludes at the point of extending that the remaining lease term at that time is 12 months only. The question then is, can the IFRS 16 recognition exemption for short-term leases of less than 12 months be applied?
So the easy answer here is no. Firstly, just to remind everyone, our intentions with the short-term exemption is to get the really simple, clearly short-term leases off balance sheet as a purely cost-saving measure. We never intended to exempt leases that were more complicated than those short, simple leases. Now, using the words that are actually in IFRS 16 and specifically paragraphs 20 and 21, what we have here, in fact, is a revised lease term. In this example, the lessee is exercising an extension option that it did not previously include on the balance sheet, and therefore must revise the lease term and remeasure the lease liability and the right of use asset accordingly. The lessee does not treat this revision of an existing lease that is already on the balance sheet as a new lease to which an exemption might be considered. I think it's also good to remember in thinking about this example, though, that the lessee also needs to think about all of the lease term guidance in the standard when it comes to consider its change in view to add the extra year. So if I think about this, is the lease term at the end of the 10 years really 12 months? What have they done that would lead them to suggest that it's not reasonably certain that they'll extend beyond that additional 12-month period? And that would be part of what they would need to think about.
So that completes all of the implementation questions that we'll be discussing today. Thank you very much for your insights, Darrell. Have you got any final thoughts to add before we wrap up?
Thanks, Catherine. Yes. IFRS 16 is a standard that focuses very much on the economics of lease contracts. And that approach is no different when you start thinking about the lease term. So clauses in contracts that have no economic substance are not relevant to any of the assessments that you make. Putting that again in the context of lease terms, if neither party is realistically going to exit, then it's likely that you will need to see it as an enforceable contract, applying the words that are in IFRS 16. A reminder on lease terms, we're aiming for the period of time a lessee realistically expects to use the asset. Extensions and breaks with no substance won't be enough to shorten the IFRS 16 lease term. Shorter lease terms will only be the case where there is real flexibility intended to be exercised in the contract.
Thanks, Darrell. Just to note, this final slide provides a link to where further information about leases implementation can be found on our website. The leases implementation page summarises all of the work the board is doing to support implementation. Within that, there's links to previous IFRS 16 webinars. We thank you for listening to our webinar and hope that it was helpful.